yesterday. And of course, the sell-off spurred by concerns over the debt crisis in China and its property bubble unwinding. Chinese property developer Evergrande hitting 11-year lows as it approaches Thursday's debt payment deadline. There are reports that say Beijing is unlikely to bail out the group as other Chinese companies suffer as well. Another Chinese property developer, Cynic, plunged 87% before shares were halted. Let me just point out that the Chinese stock market has been closed for holidays. It reopens tonight. So this will be the first opportunity for Chinese investors to react to the situation unwinding for Evergrande. That may very well play out on Wall Street tomorrow. Joining me right now is the former senior director of international economic affairs at the Reagan National Security Council. He is the former chairman of the Congressional U.S.-China Economic and Security Review Commission. Roger Robinson Jr. is here. Great to see you, Roger. Thanks very much for being here. I want to start with this Evergrande situation and get your take on the potential contagion effect. Tell me what kind of an impact you see from this property unwind in China.
Well, Maria, of all the sectors of the Chinese economy where you don't want to spark contagion or spook investors, it's got to be the property sector. I mean, combined, it's said to be 28% of GDP. I mean, Evergrande, in my opinion, is on its way into the pantheon of Chinese financial blunders. Up there with Ant Group, IPO fiasco, Alibaba, and then, of course, the DD Global debacle. So we're going to see this thing unfold in a very serious, profound way. I don't think it's going to be as containable. I mean, look at the contagion so far. The second and third tier real estate companies in China, Fantasia, Guangzhou, R&F Properties, even Hong Kong's giant Henderson Land, all have been hit with sell-offs. You've got now a 90% drop or so in Evergrande. You've got its bonds trading at 20 cents to the dollar. The second, third tiers are maybe 60 cents to the dollar if they're lucky. But this thing is moving out, and it's going to be a serious set of knock-on effects that I don't think have been fully appreciated to date.
You know, there was one source yesterday who told me that they believe there are people on the board of Evergrande that were critical of Xi Jinping. And they made some critical comments about him, and as a result, they believe that Evergrande will not be bailed out by the CCP. And of course, it's part of this massive crackdown that the CCP has been doing on business overall. But Roger, tell me who you think is most exposed in the United States. You know, there was that sell-off yesterday, partly on fears that this could have, you know, a contagion effect, and it could be China's Lehman Brothers moment. Do you see U.S. financial institutions getting impacted from this Evergrande situation?
Well, first, I mean, we need to remember that we're talking about a company here that is going to have to be bailed out in whatever manner China tries to disguise that. They'll talk about it as a restructuring, but it is headed the path of Huarong Asset Management, Angbang, and HNA. You've got not only 129 billion in short-term payables at Evergrande, but worse still, you've got 1,400,000 unfinished apartments worth $200 billion. There's no way the CCP can walk away from that kind of social unrest and upset. So we can call it by another name, but a bailout is coming, that's for sure. And I'm surprised it hasn't happened already. And every day that goes by, the market becomes, as you know, more spooked. As far as U.S. exposure is concerned, I understand that Evergrande is traded on the OTC, something that the SEC never looks at those hundreds of Chinese companies, by the way, best I know. And BlackRock and Vanguard are perhaps two of the three largest holders of Evergrande, but not in sufficient numbers that would have effect on them. Nevertheless, these are the same folks that are bringing you Chinese companies that are linked to enabling genocide, that are trafficking in slave labor, equipping concentration camps, manufacturing advanced weapon systems for the PLA. In other words, the diligence that's taking place in the United States and the lack of investor protection at the SEC, even though they've made this latest anemic selective effort to enhance disclosure requirements, we're just not anywhere near where we need to be in this category of investor protection.
Yeah, I'm glad you mentioned BlackRock, because just recently BlackRock actually told their investors that they should ramp up investing in Chinese companies. They told their investors that they should increase ownership of Chinese companies by 3 times, Roger. Now, you and I have had this discussion about owning Chinese companies a lot, and I want to talk about that because the Securities and Exchange Commission, Gary Gensler, chairman, was with me recently, and he was talking about ensuring that Chinese companies follow the rules of the road in terms of accounting standards here in the U.S., but it's quite selective, isn't it? I want to ask you about the scope of Gensler's disclosure-oriented measures and what he's doing, because you and I have spoken a lot about variable interest entities where an investor owns a company, but it's really just a shell from the Cayman Islands. Tell me about what you're seeing at the SEC and this movement to ensure Chinese companies follow the rules, and why BlackRock would be telling their investors to ramp up their investment in Chinese companies by 3 times.
Well, first, on variable interest entities, I think it's the most scandalously deceptive financial structure that I've seen in my over 40 years in the business, so to speak, of looking at global finance. I mean, as you said, they own shares of contracts of shell corporations. 95% of Chinese listed companies are using this deceptive vehicle. The American people have no idea that, for the most part, they don't own one single share in one Chinese company. They have no real minority shareholder rights. They have no legal recourse. These things can be swept away on a whim of the CCP. And so that is something that the Gensler and the SEC is suggesting can somehow be reformed with more disclosure requirements. That's absolute nonsense. I mean, in my opinion, these things have to be eliminated immediately because they can't be reformed. And so that's a case of selectivity. In the case of the OTCs, OTC market, you have hundreds of Chinese companies that don't come under scrutiny. Where are their disclosure requirements? And the most important, as we've talked about, are the A shares. I mean, these are companies that, as you know, are brought by the hundreds into indices and into the exchange-traded funds of the BlackRocks, the Vanguards, and others. And there we have an incredible circumstance where they avoid any kind of regulatory oversight. There's no real diligence performed. Are they sanctioned by the United States? Are they bad actors from a national security and human rights point of view? Those are where the problems generally lie. There might be as many as 1,000 or more. Did Gary Gensler mention requiring disclosure of the type he's talking about for listed companies, for the A shares? I didn't hear that. And so that is the kind of problem we're facing. Wall Street wants to protect those A shares like there's nobody's business. I mean, that's for sure.
Yeah. And
so the VIEs and the A shares should be right at the top of the list of areas that require the most urgent attention.
Yeah, we should also add that not one company was added to the capital market sanction list since June 3rd announcement of all of this new regulation and this forcing of these companies to follow the U.S. rules.
Indeed. I mean, we are not where we need to be. We're not as serious by any measure as is required by the circumstance.
Roger, it's great to get your insights on this.